Good morning, everybody. This is Brittany Jennings. We are live today from Seniors Blue Book with the pleasure of speaking with Bruce Ficken with BBF Capital Advisors. So good morning.
Brittany, how are you today?
I'm doing fantastic. It's a beautiful day in Sarasota. How are you today?
I'm feeling good.
Good.
Happy to be here and with you and partnering with Senior Blue Book.
We're so happy to have you. Bruce has, just in talking to him just before this, a wealth of information. So I'm excited for everybody today to kind of join in and listen to kind of our topic is the 10 Commandments of Smart Money. And Bruce is going to really jump into some questions for planning for retirement, which is something that we all definitely need to do. Without further ado, we will go ahead and get started. So can you tell me a little bit, Bruce, just personally your background and kind of how you got into the financial advisor type of role?
Well, Brittany, sure. I can tell you that my licenses allow me to help people with investments and planning. I work with LPL Financial, which is the #1 largest independent broker-dealer in the United States.
Awesome.
What that means to most clients is that the advice is unbiased and independent. It's not a proprietary solution. We're empowered to find the best solutions. I work for some of the biggest banks, investment companies, insurance companies around the globe, and they tend to sell their own products.
Sure.
And many of them take a suitability standard to promote those offerings. I tend to take a higher standard, that being the fiduciary standard, which puts the importance, the goals of the client first and foremost. That's very important. Many times the road from point A to point B has some detours and curves, and we try to help keep them focused on getting to their destination.
Absolutely. So you take an unbiased approach, a family approach. You treat people, your clients, as if they are, you're giving advice to a family member.
Correct.
Awesome.
Correct. And it's a higher standard of the fiduciaries. I would say someone you love, someone you care about, someone in your family. Would you recommend this to your mom or someone in your family that you love? And I think that's one of the litmus tests as to what if you're offering something that passed that test.
Absolutely. Well, good. Well, I know you need to, we definitely need to read this disclosure that you have for our audience members before we kind of dive into some of the specific questions.
Well, Brittany, thank you for that. We are in a highly regulated industry. We are a very strong fiduciary protecting the client. But here's the disclosure. Here goes. The opinions voiced are for general information only, and they're not intended to provide specific tax advice or recommendations for any individual. No strategy assures success or protects against loss, and all investing involves risk, including loss of principal. Guarantees are based on the claims-paying ability of the issuing company. All right?
Absolutely.
Got that out of the way.
So tell the audience, what types of services does a financial advisor provide, and how do you help for planning for retirement?
I like the question. Brittany, I would start off by saying that not all advisors are alike. The licenses that they hold, the firms that they represent, play a big role in how they operate and the kind of suggestions and recommendations that they make.
Okay.
How they get paid matters. And clients should simply ask, how do you get paid?
Yeah, that's a great question to ask.
Okay. Generally, financial advisors help with the advice, implementation, and monitoring of a financial plan. These solutions can vary widely. In my view, the solutions should start with the client's objectives.
Absolutely. So that's the starting path. And so what type of services specifically can a client come to you for?
Sure. Brittany, these services include investments. They include cash management, tax and insurance planning, legacy planning, or objectives. Sometimes there are trusts. Sometimes people want creditor protection. Things like retirement and estate planning. And a lot of advisors have a unique expertise in some of these niche areas. One of the things I like to do with a client that not everybody does is I simply ask them, what does retirement mean to you?
I'm sure it's different for every single client.
That's right. Most people think about retirement, but they don't get a clear visual. And so I'll ask, well, what state do you think you'll be in? What kind of home might it be in? Can you describe it to me? Are you around family? What kind of activities do you want to be involved in?
Pickleball.
All right, that works. Whether it's recreation, travel, nonprofits, charities, schools, churches, schools, whatever your passion is, when they say it out loud, it can be helpful in creating a plan.
Absolutely. Okay. And tell us, in working with clients, is there a risk, to the client? How do you explain the risk to a client?
That's an extremely important question. I'm glad you asked it. And the word risk has different meanings for a broad audience. What you might consider risky, I might think is something different. So it's important that the client be on the same page as the advisor. And the advisor is just a rogue and does what they want, and without input or sensitivity to risk, that's a problem. I would say that we can make decisions that can reduce risk, modify it, but we cannot completely eliminate it.
Sure.
And that comes in different ways. And so sometimes, for example, a client might say to me, Bruce, I don't want to lose any money. And then at the risk of sounding like a smart aleck, I'll say, well, what exactly do you mean by that?
Because that person could mean $1 million, or they may mean $100.
That's right. And so, as an example, sometimes folks have assets that are part of their plan and are at risk to lose money. Stocks is an example. Okay, so that can create a reclarification and understanding of what risk is and is not acceptable to the client.
Sure, absolutely. So it sounds very catered to that specific person, as you mentioned.
It's customized. Everyone. It's not just fill out a few questions, answer some questions, and he puts you in a bucket. It doesn't work that way. I customize everything.
Very good. Okay.
One of the issues we try to do is to reasonably manage expectations. Okay. If the client's expecting consistent outperformance, they may be setting themselves up for disappointment. For example, if the market's up 5 and they're expecting to get 10, they're probably going to be disappointed, and sometimes this disappointment can lead to regrettable decisions. So managing expectations is very important. And we work with clients' emotions during periods of volatility. There's intra-year volatility. There's up and down. The market, kind of goes like this over time. And there are down spots, and people get emotional when that happens. Emotionally, it's mildly pleasant to earn a 10% return, but it can be gut-wrenching to lose 5%.
Exactly.
So it depends on your client, and I tend to be more proactive in talking to clients when things are down rather than things are good.
So you're equipped to kind of, I'll use the word like coddle them, through that process, to be able to show them even history of certain stocks, to kind of show them that
that's right.
It's going to be okay.
Yes. Yes. The market has not come back.
Absolutely. So what is the best way to plan for advanced care, financially speaking?
Plan for advanced care, financially speaking. Okay. Well, one starting suggestion would be to speak with a financial advisor and or an elder care attorney. Do you have your documents in order? Do you have a will, a living will, healthcare proxy? When you go to a doctor's office for any kind of surgery, they may be asking you for that healthcare proxy. I would suggest that they get an organizer. And a simple way to put it is, where's my stuff?
Yes.
Okay. By stuff, I mean, where are your important papers? Where are your assets, your liabilities? your insurance policies, your safety deposit box, your passwords. Some folks just don't know, and during a time of stress and crisis, the family comes in, they can't find things, and it's a very difficult thing to do. So this organizer, which lists the things that I mentioned, and I people who work with me, I'm happy to share it. It's a gift. It's a loving gift to the family.
For what's already happening to your loved one, to add on the stress of having to figure out a password or things like that. Absolutely. And this is for any age. I mean, I'm in my 30s, and so this is something that could happen to anybody at any point. So I think, what age group would you say, like, does somebody need to start kind of planning their documents, or would that be like age 18, or is that something that you kind of deal with?
Brittany, I would say the first thing would be, if you are a parent, you ought to have a will.
Absolutely.
We don't like to think about these things. Sometimes it's more fun to plan a vacation than to plan, tragedy. And I don't think there's a specific age, but I think people who have significant assets or liabilities or children or duties and obligations need to have a succession plan.
Absolutely.
Getting back to your original question, you asked me about advanced care. So going forward, I'm going to answer that in the context of having your documents in order, and what I think you're really referring to is long-term care insurance.
Yes, absolutely.
Okay.
So tell us a little bit about long-term care insurance and what that would cover and look like.
What is long-term care insurance? Well, it's one of the best ways to help pay for care should we need it. Care can be very expensive, and it can be a big drain on not only the finances of a family, but of the caregiver.
Yes.
Not enough thought goes into the caregiver, which has to give time, physical, mental, emotional, financial sacrifices that they go to. And one thing that is very, very alarming about caregivers, they tend to die before the person they're caring for.
There's a very high percentage of that, even just in the Sarasota area.
That's right. So the point is that caregivers need a break, and if you're depending upon your surviving spouse to care for you, factor in how that affects them and your whole family. Let's see. A long-term care benefit is triggered when a doctor says that the individual who owns the contract needs human help with 2 or more of the 6 activities of daily living. Those activities include getting around the house, eating, bathing, toileting, incontinence, dressing. It can also mean cognitive impairment, such as Alzheimer's or dementia. So when a doctor certifies they need help with 2 of the 6 activities of daily living, they can qualify for benefits. Now, the costs of long-term care include, sometimes people prefer to be in their home, and they have someone come to their home. It can be for, correct. It can be for a couple of hours. It can be for 24/7. It varies. What also varies is the type of care that you can get. Are you getting a nurse? Or are you getting a neighbor? And some of these policies spell out the credentials, if any, that need to be possessed by the caregiver in order to get a benefit paid. There are reimbursement policies and there are indemnity policies. The reimbursement is you show a receipt and you get paid back. Indemnity is you qualify, here's the money, spend it as you like.
Sure. And what would be a good example of what a policy might look like dollar-wise and how that breaks down?
If you're talking about home care, it's typically somewhere in the neighborhood of $15 to $18 an hour. Now, unless you have a very close relationship, they typically don't come in for just an hour or 2 to make your meal or clean things up. They usually have a minimum number of hours that they require. the assisted living facilities you mentioned. The lowest price that I've seen in the past year was $3,000 a month, and it was very modest accommodations.
Sure.
I would say in this area, you're generally in the $4,000 to $6,000 a month net out-of-pocket expense for an assisted living facility, and some are even more expensive.
Correct. That'd be for a one-bedroom apartment, maybe a studio, or even a shared accommodation.
Exactly right. They should not expect luxury accommodations for an assisted living facility. They can be modest for a lot of money.
Absolutely. So a typical policy, we were kind of talking a little bit before this, maybe like around $250,000 for a long-term care policy. And how would that work? Is it something that they pay monthly, or how do they kind of divvy out that bank of money for care?
Okay. Well, I need to break it down a little bit here. And you mentioned 250,000, so I'll lead into answering that question if that's okay.
Absolutely.
There are different types of long-term care insurance policies. You can have a standalone policy, which is exclusive to the 2 of the 6 activities of daily living. You can have an annuity, which might leverage the amount invested. You may have a hybrid life insurance policy that creates a large pool of money for long-term care, coupled with a tax-free death benefit. And also you have life insurance policies, which may have a rider allowing folks to have access to the death benefit. Going backwards just a step, I did mention nursing homes. They can be $8,000, $10,000, $12,000 a month, and in certain parts of the country, nursing homes, as well as assisted living facilities, those prices can be even higher. California, New York, high cost of living areas, for example.
I mean, that's a huge number, $12,000 a month, or maybe more. I mean, it's
An elder care attorney told me that from an actuarial standpoint, you cannot pay total long-term care insurance premiums that exceed, in your lifetime, 1 year in nursing homes.
Oh my goodness.
It is, from a financial analysis standpoint, if you can afford the premiums, it's one of the most intelligent things you can do to prepare for retirement.
Okay.
I sometimes tell folks, don't over worry about fully funding every possible scenario. Having something in place can be leveraged along with your family and circle of friends to get help. Getting back to your $250,000 situation, I mentioned the pool of money. Part of a long-term care policy creates this pool of money, and the policy document spells out how it can be accessed. So if you qualify in this example, let us suppose that $250,000 can be paid out over a maximum term of 5 years. In that example, the math is 250 divided by 1,000 divided by 5 years, 5. That's $50,000 a year. $50,000 a year divided by 12 months is $4,166.66 a month. So in your example, the owner could take out $41.66 a month to pay for that care. They can take out less, and they can make it last even longer.
Right.
But that's how the maximum kind of works. So take, for example, a long-term care, an assisted living facility that charges, say, for simple math, $5,000. You take the $4,166, and then you or the family's got to pitch in another $833 for the full $5,000.
Which is much more reasonable than paying the entire figure.
Well, right. You're paying $10,000. $833 times 12 is $10,000 versus $60,000 net out of pocket to pay for the care.
Absolutely.
And you're living pretty well for the $5,000 too, by the way.
Oh yeah, get you a beautiful place here in Sarasota.
Yes.
Or even in-home care would get you a good number of hours. So, okay.
I've often heard people say to me, they say, it's too expensive, I'll do it when I'm older. And then I've heard folks who are older say, I should have done it when I was younger.
It reverses.
And so the point is, and this is important, it's not so easy to get these policies as it used to be. The underwriting of a morbidity condition is different than a mortality condition. we're living longer generally, and often with chronic conditions. Okay? So there are fewer insurance companies today than there were 10 years ago that offer long-term care. And they're getting tougher and tougher with their underwriting requirements. So those that say, oh, wait till I'm older, you might be uninsurable.
Right, exactly. You may not be able to qualify.
Plus,
correct.
the premiums are higher.
Mm-hmm. So what would be an ideal age for somebody to start looking into this, to look into long-term care insurance?
Well, I think one should start thinking about it seriously in your 40s. In my opinion, they should take action in their late 40s or 50s. You are rolling the dice risk-wise as far as the underwriting is concerned if you wait till after 60.
And the premium goes up, it sounds like.
With every year,
yeah.
Every birthday, the premium, the longer you wait, every birthday, the future premiums are likely to go higher.
Okay. All right. Well, that's definitely important information for everybody to consider for themselves personally. And also, so what programs are available that pay a monthly fee after we would retire to ensure that we don't run out of money? Because that's the big question. You know, people are afraid that they're going to outlive their money, their resources.
Brittany, I agree 100%. One of the biggest fears that seniors have is simply running out of money. So what do they do about it? One would be to be mindful of the percentage of your retirement holdings or other holdings that you're taking out to live your retirement lifestyle. If you're 65, if you're a married couple age 65, takes out 8% of their nest egg every year, they might have it all gone by the time they're 81. And that's their worst nightmare. Imagine being 81 years old and have to move out because you can't afford your home anymore. Okay? So 5 or 6% is a little safer. It's not foolproof. Sometimes we're living into our 90s and 100, and 5-6% might even be too high for that. So
sure.
Longevity in your family
people are definitely living longer.
Consideration. Mm-hmm. That's right. Modern medicine, better nutrition, better medicine, better health care is helping our longevity. In the 1930s, when they started Social Security, most folks are already gone by age 65. Mm. Now we're living multi-decade retirements.
Yes.
And we need to prepare for it. Getting back to answering your question, one should typically have diversified quality holdings. They should be cautious about fees and taxes, and to watch their personal budgets and income and expenses. But what I think you are really referring to is that there are contracts out there that guarantee income for life. And I think you're referring to a guaranteed minimum income benefit and of an annuity contract.
Yeah, absolutely.
An annuity is a contract between an insurance company and an individual or an entity. And within that contract, it spells out what the fees are and what the promises are.
Okay.
And it is common out there that if you pay a fee, they will guarantee a specific amount of the benefit or the holding that you have. They'll guarantee a certain payment for the rest of your life. Now that sounds good.
Yeah, it does. It sounds exciting to somebody, especially thinking about, not to get on that topic, but Social Security for down the road for us. You know, this is sounds like a better guarantee of how we can best set ourselves up for that.
Keep in mind that there's going to be some give and take. Okay? An insurance company is a for-profit entity. So if they're giving you something in the form of peace of mind and a lifetime income guarantee, they're probably getting something back.
Sure.
Which is either a fee and or limitations on what you can do with your money that's associated with that contract. Okay. You might get a lower rate of return on your investments if you opt for that income guarantee. It's nice to have, and generally speaking very broadly, people tend to live longer when they know that their income is guaranteed.
So just asking a question from that type of contract, so is that something that they can specifically tell you, or you could use that money for in a very specific way? Are we talking for care? Are we talking for, I don't know, for a mortgage? You know, what type of contracts, just kind of on a broad spectrum, would you say that exist?
Well, the types of contracts, the sophistication, the enhancements have changed and will continue to change with our society. You have disability income contracts with all kinds of riders and shapes and sizes. And we mentioned the annuity contracts. Some of them are very simple. You might have a fixed interest rate and there's no cost to it. Some of them can be highly complex because of the way that they invest the money and the promises that they make. And they should talk to their advisor about the details.
Sure. Make sure they pick the right one for them specifically.
Be careful about, sometimes they will lead with the smiley face parts of an annuity.
Sure.
And it's important to talk about the frown parts too. So for example, there may be penalties if you withdraw the money too soon.
Sure.
Okay. There may be limitations as to how much of the money you can get without a penalty. And what is that penalty and how can it affect the future of that contract?
So really weigh out the pros and cons.
Correct. And know what they are.
Yes. So that's why we would come to you, Bruce.
That's right.
So, kind of back on the 10 Commandments of smart money, Bruce has been kind enough to kind of give us those 10 Commandments. And so I'm going to let him take it from here and really go through those 10 Commandments of smart money.
Brittany, this is not scientific. It's kind of my own personal spin on the event, which was the 10 Commandments for financial planning. So, and this is not in order or priority per se, but I'll just dig in. My first one would be to work with professionals that have integrity, energy, and intelligence. And if they don't have the first one, the other two don't matter. Get yourself an edge.
Mm-hmm.
2, get real.
Mm-hmm.
Be real about your health, your finances, the risk you're willing to take, what are reasonable expectations and objectives. 3, look forward. What do you think is going to happen? And plan for it. Take action. 4, get your documents in order. Have your organizer. It's such an important gift to your family. It's a gift of love, the organizer. Get your will, your healthcare proxy in order. You may have a deed. You may have insurance policies and other documents, stock certificates. Make sure that's in order and that someone you love and trust knows where it is.
Mm-hmm.
Okay? Know where those passwords are.
Oh, yes.
5, plan, review, and monitor. From point A to point B is not always a straight line, and sometimes we need to make some changes. Sometimes the financial markets change. For example, interest rates are super low right now. So sometimes we need to take corrective action. 6, don't be too greedy. You'll get yourself in trouble if you think that you are entitled to outperformance. Okay? 7, and this is probably number 1, take care of your family. What are they going to need if you're not around?
Exactly.
8, don't be a know-it-all. You're not.
I know I'm not.
That wasn't personal, but
No,
a lot
I know.
of folks think they know it all, and they don't. When recognizing that is the first step.
Mm-hmm. Allow yourself to learn and really look at
There might be something you didn't know
different.
that can be very helpful.
Mm-hmm.
Things change. You didn't know about the change.
Right.
9, and this is my own spin. Boring is good. And what I mean by that is, if from an investment standpoint, I tend to stick with high quality assets.
Mm-hmm.
When you start to get cute, when you fail to recognize the nuances and the true risks of some of the options that are out there, you may not truly understand them. And in my opinion, sticking with tried and true high quality is going to work better for what's new, what's complicated, what's sexy, what's promising. I would differentiate some of your short-term money with long-term money and stick basically to boring high quality.
I would agree with that. It sounds more successful in the long run and more, I like to take a little risk, but I think that that's something that most people need to recognize as being a great long-term plan for retirement.
Brittany, the last one is to keep an eye and try and minimize your taxes and fees. That's going to have a material impact on the rate of return and how long your money lasts.
Okay.
Taxes are often the number 1 biggest expense in retirement.
Mm-hmm.
Some people think it's healthcare or housing or spoiling their grandchildren. It's it's usually taxes, such as withdrawing money from an IRA is usually taxed.
Okay. Well, very good. Well, I know I've learned a lot today from Bruce, and he's been kind enough to spend this time with us to really dive into what he can do for clients. And I think everybody in the Sarasota area should definitely check out Bruce and see if he's a great fit for you. As he mentioned, there are a lot of factors in retirement, and definitely. I guess for me, I would love to come in and meet with Bruce personally because I think it's just important to mention that not just people that are certain age brackets, but I think everybody needs to be aware of what's out there. And as you mentioned, things are changing, and we need to make sure we're in front of this instead of on the behind the ball type of situation. So I want to thank Bruce for being here. So
Brittany, a pleasure.
You're wonderful, and everybody, thanks for tuning in, and we hope that you have a wonderful day.